Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, how to fund your solo 401k. So this is going to be pretty quick, easy, and short video because it's super easy to fund your solo 401k. Not a lot of rules. And there are so many opportunities to supercharge your retirement savings, generate a great investment vehicle to invest in traditional as well as alternative asset investments, all through the solo K. So I will spend a couple minutes for any newbies talking about just some of the benefits of the solo K, how it works, and then we're going to get into the funding of it. And when I mean funding, I'm going to talk about contributions. I'm also going to talk about rollovers, transfers. Basically, how do you get money into your new solo 401k or maybe even to your existing solo 401k. So as I mentioned, it's going to be quick, easy, fun. It's Friday afternoon, so it's going to be a lot of fun. So let's rock and roll and get started. So here's some information about me. As you guys know, I've written 8 books on self-directed retirement accounts, including Solo K in a nutshell. I'm actually working on 2 more books. I haven't released a new book in a while, I think since 2021. So I have 2 books I've been working on that I hopefully will publish this year. And they're going to be really about mastering the self-directed IRA, mastering the solo K. I'm going to go a little bit more in depth than the nutshell. So check out those and definitely be on the lookout. But obviously, I'm a tax attorney. I have a master's in tax law. And I founded IRA Financial really to educate and help people unlock their retirement money, tax optimize their retirement, be able to invest in almost anything they want, take control of their future, and become 7-figure rich when they retire. So that's what I'm about. So as I mentioned, I'll spend a couple minutes on the solo K. I always like to kind of introduce it just in case this is the first video you're encountering on the solo 401k plan. So just in a nutshell, the solo 401k is basically a regular 401k plan that applies to folks that are self-employed or have a business with no full-time employees other than the owners or their spouses. Okay, so if you work at Tesla, you can't have a solo K. But if you are your own consultant, you have a business where it's just you and the spouse, or maybe just you and the partners, then you can certainly have a solo 401k plan. So it's not a new plan. It was created by ERISA in 1974 when IRAs and 401ks were created. 2001 when extra economic growth, tax relief, and reconciliation, when it was launched and made law, that's when it added a lot of amazing features to the solo 401k, such as the Roth option, the loan feature, and the deferral feature, which essentially made the solo 401k the most powerful and robust retirement plan for the self-employed and small business. So since 2001, the solo K has outpaced and out-trumped the SEP IRA or really any other retirement plan, including the simple IRA, and Roth IRA. So who's eligible, as I mentioned, for the solo K? 2 simple requirements. You need a business. It can be anything. You could be a consultant, engineer, lawyer, doctor. You can sell shoes on eBay. You don't need to have a $1 billion business. It doesn't even have to be your full-time job. It could be a part-time gig, which makes it super attractive, right? So you can work full-time at Tesla and then maybe do some consulting on the side. And then you can also set up a solo 401k for your side business. Okay, and we'll get into some contributions and funding options as well. And why would you do that? I mean, it's really about getting more funds in a solo K, being able to put away more money for 2 reasons. Number 1, to save more. Number 2, the solo K is a great investment vehicle because, as I mentioned, you can do traditional as well as alternative asset investments, which you're not going to be able to do if you work at a large company because you're going to be limited in terms of the investments you can do based off their 401k plan. So super easy eligibility requirements. Any business can set up a solo K, sole proprietor, single member LC, C Corp, S Corp, partnership. As long as you satisfy the eligibility, you have a U.S. business, you're in. And again, it can be a part-time business. You can drive Uber, or it can be your full-time gig. You are a lawyer, an architect, consultant. You can take advantage of the beautiful solo K. So what are the tax advantages of the solo K? Obviously, just like an IRA or a regular 401k, the money in the plan grows without tax. That's known as tax deferral. Your money is going to grow faster when it's not subject to taxation. It's the rule of 72. Assuming an 8% rate of return, 9 years, your money doubles. Okay. On top of that, the solo K was going to let you do alternative asset investments, whether it's real estate or private equity, venture capital, cryptos, gold, hard money loans, credit funds. You're not limited. The only two things you can't do collectibles like artwork, and you can't do any transaction under 4975, which essentially does not allow you to do any self-dealer in a conflict of interest transaction between you and a disqualified person. Disqualified person is defined as you personally, your lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons, 50% or more. Otherwise, you can do it. Okay. The solo 401k also has a loan feature. It's going to let you borrow $50,000 or 50% of your account value, whatever's less. Use that loan for any purpose. Pay off debt, go on vacation, send me money. Just joking. Anything you want. It's a 5-year loan. You can prepay it if you want. You have to pay it back at least quarterly at an 8.5% rate, prime rate, which as of May, 17, 2024, is the prime interest rate. I can say you can do more, but 8.5% is pretty high interest rate. For example, during COVID, it was 3.25%. But the good news of paying yourself a higher interest rate is the money's going to you. The money's going to your plan. So it's basically a rate of return on the free money you're getting, because you are getting tax-free, penalty-free use of the money to use the money for any purpose, and you're paying yourself back that 8.5% rate of return. The solo K also has the checkbook control. So you as the trustee, you have checkbook control to make investments by simply writing a check. You don't need to go through a custodian. Unlike an IRA where the custodian, IRA Financial, is the trustee of your IRA. In the 401k, solo K, you are the trustee. So you automatically have checkbook control. You don't even need to use an LLC. You have checkbook control straight away from the plan, which is super attractive. Also, the solo K has something called the mega backdoor Roth, which will let you put away in 2024, 69K, all in Roth, dollar for dollar, which is almost 10 times as more as a Roth IRA. And if you just worked at a Tesla or Fidelity or IRA Financial, you'd only be able to put away up to $23,000 or $30,500 if you're over 50 in Roth. The mega backdoor solo will let you go dollar for dollar up to 69K, and it's 66K in 2023. So if you are a Rother like myself, it's an amazing way to supercharge your Roths, and generally not going to be able to do it in a regular 401k because the backdoor Roth is subject to top-heavy testing, deferral contribution percentage testing, which if not enough rank and file employees do it and too many executives do it, you're going to fail the top-heavy test, and you're not going to be able to do the contribution because it will not be respected by ERISA. Solo K, there's no testing for that. Generally, it's just you and maybe your spouse, so you're not going to have to worry about that. On top of everything I just mentioned, if you're a real estate investor, you want to use leverage. Who doesn't want to use leverage? With a solo K, you can use a non-recourse loan to buy real estate without triggering the UBIT, which is a really dirty 4-letter word. Whereas if you used an IRA and a non-recourse loan to buy real estate, you would get hit with this UBIT tax. So this is very important. Not all plans are the same. Why? If you go to Fidelity or Vanguard and get a plan, you're not going to get a checkbook control plan. You're going to get a boring regular plan that's going to let you do traditional investments. Not going to let you do the backdoor, mega backdoor Roth. It's not going to let you even do a loan in most cases. So it's just kind of a very standard plan, vanilla. But if you want something robust, especially if you're into alternative asset investments, you want ultimate freedom and control, then this solo plan that IRA Financial works with is a game changer, right? Because Vanguard, Fidelity, Schwab, they're going to give you a plan that's going to only allow you to buy investments they sell. No, I don't blame them. If I ran Fidelity or Vanguard, I would do the same thing. That's not our business, right? We don't sell products. We're not the Fidelities, right? That's why you come to us. You don't want the boring old business companies. Those companies, they're going to be gone in 15, 20 years. Why? Because people like you are waking up to saying, hey, the tax code gives me control. I don't need to use those guys. I can do investments I want to do. Now, I can also use them if I want to buy regular S&P 500 spiders or Tesla or Apple stock. But if I want to do other stuff, I can get a plan through IRA Financial. I can also use a brokerage account with the plan, but I'll have checkbook controls and trustee. I'll have the mega backdoor of the loan, the ability to do alternative asset investments, more control. Why would I just do a boring plan? And on top of that, we handle all the admin. If you get a free plan from Vanguard, Fidelity, or Schwab, you're on the hook for all the admin. They're not doing anything. And I probably get 50, maybe not 50, probably 30 people that reach out to me a month saying, Adam, I have this 401k solo plan with name the institution. I just realized they never did any of the admin. They never did 5500s, 1099Rs. They said I was responsible, but I got the plan from them. They're the financial institution. How could they have not done that? And this also applies to the UBIT. They never filed anything. So you get what you pay for. They're going to give you the plan for free. They're going to do nothing. They're just going to let you buy their products. That's not the future. The future is freedom, right? Unlocking. It's in the tax code. The tax code never distinguishes between retirement accounts that invest in traditional, retirement accounts that invest in alternative assets. The IRS only wanted you to buy traditionals. They would have said that in the code. They would have just restricted retirement account investing to traditionals. They never did that for a reason. They want you to diversify. Okay. Let's talk about funding. That's the whole point of today's video. So basic ways to fund a plan. I'm going to end with contributions. Let's just talk about, hey, you set up a solo 401k with IRA Financial. Now you need to get some cash in it. Why? Because you want to make investments. So the easiest way is you move money from an IRA. Any IRA except a Roth IRA can be moved into a 401k. A SEP IRA, traditional IRA, even a simple IRA can now be moved into a 401k tax-free. These are tax-free rollovers, okay? The difference between a transfer and a rollover, and I wrote transfers, it's really a rollover. Why? Transfers only means IRA to IRA. Rollover is IRA to 401k. So transfer, rollover, same thing, but tax-free rolling over a traditional IRA, SEP IRA, simple IRA into a 401k. The only IRA that cannot be rolled in is a Roth IRA. Another popular way, you leave your job, right? You work at company XYZ, you left after 12 years, you have 300 grand in your 401k. You can now do a tax-free rollover of those funds into your new solo 401k, okay? In order to move money out of a 401k, you need what's called a triggering event, which I'm going to get to in the next slide. But when you leave your job, that is a triggering event. So you can then take the money in your 401k and then move it to the new solo 401k that you're going to set up with IRA Financial. Tax-free. Just like the IRA, here you're doing it from the 401k world. Same rules apply to a 403b, a 457b if it's a government plan. Okay, same rules. It's all tax-free. You generally need to trigger an event if the money's coming from a 401, a 403b, or a 457. Termination of employment is a triggering event. Hence, you'll be able to move the funds tax-free from your former employer and into the new solo K. And by doing that, you're going to get the ability to invest those funds in traditional or alternative investments. And that's, obviously one of the reasons I assume you're going to be interested in setting up the solo 401k. Roth 401ks can be now rolled into a Roth 401k. So solo 401k, excuse me. So if you had a Roth 401k with IRA Financial, you worked for IRA Financial, now you're going to start your own business, hopefully not compete with us, but do something else. And you had a $25,000 in your Roth 401k, you can move it into the solo 401k tax rate. That is permitted. Okay. You just can't move a Roth IRA into a 401k. That rule will change. There was rumors that was going to be part of Secure Act 2.0, which was passed in end of 22. It never became law. It never became part of the plan. So that will be part of future legislation. I don't know when, but the rule's stupid. It makes no sense. If you can go Roth 401k to Roth IRA, why can't you go Roth IRA to Roth 401k? No one's ever given me a good reason. So it will change. We're just stuck with the old rules. Distributions, I talked about this. Before I get into distributions, let me go back to contributions. So this video really talks about funding from outside sources, right? IRA rollovers, SEP IRA rollovers, simple IRA rollovers, non-Roth IRA rollovers, or a 403b, 457b, or a Roth 401k. That's the most common way to fund a 401k with real money. Other ways is through contributions. right? And there's three types of contributions. There's employee deferral, employer contribution, and then the mega backdoor. So the employee deferral in 2024, dollar for dollar, you can put away $23,000 or $30,500 if you're over 50. That could be in pre-tax or Roth. And then you can do 20% of your net Schedule C if you are a sole proprietor or a single member LC, up to an aggregate amount of $69,000 or $76,500 if you're over 50, right? So if you made 100K, you can do, and you're under 50, sole proprietor, you can do 23,000 plus 20% of 100 or 20,000. That's 43K. If you're an S corp over 50 and you made 100K, you can do 30,500 plus 25,000, 25% of your 100K W2. For CS or partnership, it's all based off your W2 or guaranteed payment. If you're a sole proprietor, single member LC, it's all based off your net Schedule C. So that's the employee deferral and then the employer. And then the mega backdoor allows you to go dollar for dollar up to 69K. If you made 100K and you are under 50 and you just love Roth, you can just go dollar for dollar up to 69K. You will not get a tax deduction, but so long as you're 59 and a half, the Roth's been open at least 5 years, you would be able to pull all the money out tax-free. That's obviously the really, really exciting part of that strategy. You don't get the current tax deduction, which isn't always positive. It happens, but, and this is my but, I feel I can make more sheltering all my income and gains from tax in the plan over a 10, 15, 20, 30 year time period versus a current 30, 35% deduction on the amount I contribute. That's just my decision. You guys can do whatever you want. The good news with the plan is it gives you the ability to do pre-tax as well as Roth contributions. You're not stuck doing one or the other. Distributions, right? I talked about funding. Instead of doing a different video, a separate video on distributions, I thought I would just include it here because distributions are not very complicated. And basically, when you have a solo 401k, there's the need to get a trigger event to move money out of the plan. Okay. If you have an IRA, you can take a distribution at any time. You just would pay tax and a 10% penalty if you're under 59 and a half. With a traditional, it's a Roth, you can pull your contributions out at any time. But if you're not 59 and a half and the Roth has not been open at least 5 years, it's subject to tax and a 10% penalty. With a 401k, you can take money out of your solo K so long as you close the plan, right? You're not going to leave the job because it's probably you, but let's say it's you and your spouse, and your spouse says, I'm done, I want to retire, I don't want to do this anymore, but you do. Your spouse would then be able to have a trigger event because he or she is no longer an employee and could then move the funds into an IRA. Or let's say you just shut your business down, you're consulting, now you're going back to corporate America, or maybe you're just retiring, then you have a trigger event, and then you can move the money into an IRA or just take a distribution. If you need to get access to your money and do not have a trigger event, you're under 59 and a half, you're still employed with the plan, a couple options. You can do a solo 401k loan, right? 50,000 or 50% of your account value, whatever's less. You can do a hardship, God forbid you need it, whether it's medical or financial. Essentially, you can do a Rule 55 where you can take the money out from 55 for a set period of time to 59 and a half, but you're limited in what you can pull out. That's only if you retire, which again in the solo plan may not work. And then you can do substantial equal periodic payments, which are more popular in the IRA setting. But from a solo K standpoint, it's generally closing your plan, the loan feature, or hardship. Those are the main three ways to get access to your solo 401k money under 59 and a half. Okay. Obviously in a Roth 401k, the distributions are tax-free so long as you're 59 and a half. The Roth is open 5 years at least. In a pre-tax, if you are over 59 and a half, it's tax. Under 59 and a half, assuming you get a trigger event, you pay tax and a 10% penalty. If you're able to satisfy a hardship, you still pay tax, but you escape the 10% early distribution penalty. Why do people want to do distributions? Well, obviously, number one, you need the money for whatever reason. Number two, you just want to do a rollover to an IRA. Why? IRAs potentially have better investment opportunities. I don't know, but everyone has reasons. You just have to understand kind of the rules involved. It's easy to get started. Obviously, IRA Financial makes it easiest for the leaders in this space. We have an app, a website, you can get started. We have a quick account set up. Literally 25 seconds, you're done. Get all the info. We'll customize the plan. Someone will reach out and we'll white glove service, VIP service you and get you started. The important thing is the IRS has now offered a $1,500 tax credit over a 3-year period to set up a plan. All you need to do is auto-enroll the plan, which is like a checkbox that we do. It's an auto-enrollment feature, and which really isn't relevant to solo plans. It's actually probably inadvertent that this credit applies to solo plans. Most credits do not apply to solo plans. They generally apply to like ERISA employer plans with multiple employees. So this is a gift, and a $500 tax credit over 3 years, $1,500 total, saves you money. Credits are far more valuable than deductions because they reduce your tax liability dollar for dollar, whereas deductions just reduces your taxable income. It doesn't reduce the taxable liability dollar for dollar. It reduces the amount of taxable income, which would then be applied to a tax rate, which would equal the tax due. The tax credit reduces the tax due dollar for dollar, so it's super valuable. And obviously, you know, we're the best at what we do. That's why we're the leaders, fastest growing, and we literally wrote the book on the plan. So if you're trusting someone else with this, I think you're making a mistake, but that's your decision. Let's do a couple questions. It's a quick, short video. It's a Friday afternoon. I'm sure you got a lot of more interesting things to do, but my job is to kind of get you the info as quick as possible in the most effective way. Can my business be an LLC without me as a manager but beneficiary? Susan, yeah, but someone's got to manage your LLC. It can be member managed, but someone's got to manage it, right? Every LLC needs a manager. Someone needs to have the bank account. Someone has to make decisions on behalf of the LLC. So it could be you. In most cases, Susan, the owner or the person whose money is tied up in the LLC will want to be the manager. So the 5-year waiting period to pull funds out of the solo 401k does or does not apply to those over 50. Yeah, you need to be 5 years and 59 and a half. So if you start at 70, you still need to get your 5 years in for the Roth. Okay, Pete, questions. If I set up a solo 401k via a company, which is a little bit of revenue, less than 5K, but I have a W-2 income from a job, can I contribute income from W-2? No. So when you have a solo 401k, Pete, it's a great question. The money you can contribute must come from the business that adopted the plan. So if you work at Apple and make $100 million a year, hopefully, Pete, maybe let's just say you make $1 million, okay? And you get a really big W-2, and I hope you're then contributing to the Apple 401k. You should. And then let's say you have a side gig. I don't know. You make 5K doing whatever. You sell something on eBay, shoes on eBay. All you'll be able to contribute is up to 5K. Now, if you maxed out the Apple plan and you already maxed out your employee deferral, then all you'd be able to do is either a backdoor Roth of up to the 5K or profit sharing of 20 or 25% of 5K. So your W-2 would apply to the job that has the 401k. Your solo plan only would apply to the income from the business that adopted the plan, not your full-time job. But that's a great, great question, Pete. Thank you. And Susan, thank you for yours too. Vernon, IRA Financial handles my accounts. They do a great job. Thank you, Vernon. We try. I think we're the best around because it's not just our expertise, but it's our focus on you guys, customer service, giving you great content, trying to educate everyone so they become the best and most successful investment savers out there. John, is there a minimum income requirement for a solo? Okay, no. But obviously, as my answer to Pete's question, if your solo 401k business has $1,000 in net income, you're not going to be able to contribute up to $1,000. But John, here's the thing: you may not care, right? Like Pete says he's high income in this case. Okay, so let's say Pete makes $1 million a year at Apple, and he's maxes out his 401k at Apple, and that's great. But he wants to do real estate, or he wants to invest in his friend's business, or he wants to do a private equity deal. Apple's not going to let him do it. And he says, you know what? Instead of opening an IRA, I'm going to set up a solo for my little business here. Because again, the business just needs to be a business. Technically, it doesn't even have to have revenue. It could be a software development company that only has R&D, right? I need a vehicle to make the investment. And let's say there's going to be leverage, right? So I need it to be in a solo K, because if I did an IRA, I'm not going to get the exemption from UBIT, which I want, because I don't want to pay 37% tax potentially on the leverage portion of my real estate deal. So I need a solo K. So I'm going to call Adam up. He's going to hook me up with a solo K. And I'm really just going to use the solo K as an investment vehicle. Yeah, maybe I'll make contributions down the road if my shoe business grows, but I don't really care that much, because I'm maxing out my W-2 401k job, 401k at Apple, and I'm good there. I would love to put more money in a solo plan, but that's not really my prime concern. My prime concern is using that as an investment vehicle. And that happens a lot. Or on the other side, hey, I need to do a loan. You know, I did a loan with my W-2 job. I need a 50K loan from this side business. I have a 100K IRA. I'll roll the 100K IRA into the solo plan and adopt it by my small little consulting business, and I'll borrow 50K. Unfortunately, that was super popular during the financial crisis, like 2009, 2010, 2011, where I was setting up hundreds of plans a year just for the loan feature. That obviously has subsided. Now more people are setting it up either to make higher contributions or to use it as an investment platform, less so on the loan, which thank God is a good thing. But you have different opportunities, John. So that is something just to consider, that you can use it as an investment vehicle, or you can use it as a vehicle to make contributions. You can use it as a vehicle to exempt from leverage. You can do it as a vehicle for the $50,000 loan, or you can use it for all of the above. John, how does rollover of crypto get accomplished from solo to an LLC? So I don't know where you hold your cryptos. Generally, if the crypto account's in the name of the solo K, you would just open an LLC account and just literally transfer. The solo, we can draft a contribution agreement to show evidence of the contribution of the asset from the solo K of the LLC. Just let us know. We'll work with you on that. Or you can just keep it in the solo K. It's up to you. Most people will just roll cash from the solo K to the LLC and then buy the cryptos in the LLC, open an account on the exchange in the LLC. We have a really good platform with Bitstamp on our website, on our app, where you can buy cryptos directly in the IRA or 401k. We have no asset valuation fees. So if you buy Bitcoin at 50 or 60 and it goes to 200,000, you pay us the same. I think it's $100 a year, literally. So other exchanges, I'll actually do a video on this soon. They charge 1% asset valuation fee. So let's say you buy Bitcoin at 30,000, right? You wake up a year later and now it's at 100,000. You're paying them $1,000 of fees to do nothing. We don't believe in that, right? We're a self-directed company. We're agnostic and neutral to your investments. If your investment goes up because you're smarter than me, why should you pay me more money? It's ridiculous. It's unethical. I don't believe in that. So we have flat fees because I want you to make more money. I shouldn't take a greater percentage of your retirement money and put it in my pocket because you're smarter than me. So there's a lot of companies out there doing it. To me, it's sickening. It's unethical. And I'm surprised that people use those companies, but some people just don't know. They get referred to these companies. They just sign up. They don't even know different. So it just bothers me. Again, my competitors, I'm friendly with them. They're good people, but I just think it's wrong ethically to charge people asset valuation fees for like cryptos or even any self-directed account when you guys are doing all the work, not us. So it's crazy. Susan, how does the self-directed IRA component to solo 401k an amount of contribution and growth? So the self-directed IRA, you can only put away $6,000 or $7,000 or $8,000 if you're over 50. And that's obviously a lot smaller than the solo 401k, which is 69 and 76.5 if you're over 50. So the IRA is a great vehicle, okay? But I've said this, and I'll say it again. If I could put every one of my clients in a solo 401k, I would. Okay, the reason I can't is because not everyone is self-employed, right? You have a full-time job at Apple, you can't do the solo K because you don't have a side gig. You got to do the IRA. The self-directed IRA is a great vehicle. Don't get me wrong, but adding value by way of contribution is not as strong in the IRA world as the 401k. 401k, you can put away 23 or 30,500 versus 7 or 8 in the IRA. The Solo K also has the mega backdoor, lets you go dollar for dollar up to 69k. IRA Roth has the backdoor Roth, but it's 7 or 8k. So the Solo K is an amazing product. I always said if I was better at my job, I would have a million of these clients. But I'm working on it. I'm trying to educate, trying to get the word out there. Unfortunately, retirement accounts, self-directed accounts, retirement investment strategies is not as sexy as watching Kim Kardashian or some of this other stuff on social media. So just got to work harder to get more people to understand the value of the system. The U.S. retirement system is literally rigged in our favor. Unfortunately, most Americans have just not focused on the opportunity. And that's a shame. And that's my vision and my mission in life is to end that, because the retirement system is not a zero-sum game. We all could literally push the system in our favor by just understanding the rules, starting, make contributions, being consistent in how we make contributions, and more importantly, just really being patient, trusting the process, trusting mathematics, compounding returns, and just know if you sit back, keep putting money in your plan, make some investment decisions, hopefully smart ones, just watch the money grow in 10, 20, 30 years, you will have 7 figures plus in your retirement account. It's math. I know it. I've seen it with my family. I've seen it with me. I've seen it with my friends, my colleagues. It works. I've been saving I've been kind of maxing out my 401k for the last 24 years. And I have a lot of money in my retirement account, a lot. And it's going to keep doubling every, hopefully 6 years, because I'm doing really good investments in some alts. But it's simple stuff. Just people are, unfortunately, Americans, we're short-sighted. We're not savers. We think of spending. We think of the moment, and we don't think about the fact that this could be an amazing legacy to our family, right? The goal is you never need this money, right? You're saving on your own. You're going to continue working. You're going to make money, and this is really for maybe your golden years, but you may not even need that much of the money. Take some of your Social Security, and some of this money can help buy your kids a house, buy your grandkids a house, helping pay for education, taking your family on vacation, doing the great things that you want to do to create everlasting memories for your family. You can do that. This is all upon us. The biggest advantage we have is youth. The earlier you start, more consistent you are, the more time you have to be patient and watch your money grow. It's simple, it's easy, just got to do it. Okay, that's it. Okay, I think I'm good. I think I explained everything you're going to need to know about funding. It's really easy to fund. As I mentioned, there's different reasons to set up a Solo K. Some people may not even care about funding. They're just going to want to do contributions. Other folks may just care about contributions. They may not care about funding it with transfers or rollovers. Other people may not even care to do either. They just want the loan. It's up to you. There's no right or wrong. There is no requirement in the tax code that makes you fund a plan that makes you make contributions. Now, when you set up a 401k, it's supposed to be a permanent plan. So the IRS wants you to make contributions, but if you don't make contributions for a period of time, they're not going to force you to close the plan. Okay, so you have a lot of flexibility in that regard. Yeah, it's not sexy retirement accounts, but actually just watching these videos, if you have time to read blogs or anything I've written, that will be more valuable than any Ivy League degree you'll get, because this can literally guarantee you wealth. A college degree at Harvard or Columbia may help you get your first job, but it's not going to guarantee you wealth. This will, right? And you don't have to be an executive at a major financial institution or large software company. Just put away 5-10 grand a year for 20, 30 years, you're going to have money, right? And I've done the numbers. I can do them again for people. I'll give you some examples now just to throw at people, because people like numbers and they, for some reason, don't believe everything I say. So, as I mentioned, let's say you are, let's do some numbers. Let's say you make, I don't know, $80,000 a year, right? 30 years old. You have zero in your 401k. you're going to put away 10% of your salary, so $8,000, okay, and no match, okay. Say no match, okay. 30 years old, $10,000. You're going to do it till 7 years old, okay. Say no salary increase. Say an 8% annual rate of return, okay. You're going to have, let's see what you're going to have, $2.15 million. Okay, so if you put 10% of your $80,000 salary away, $8,000 a year from 30 to 70, assuming an 8% rate of return, you're going to have $2.1 million. If you're able to get a 8.5% rate of return, you're going to have, $2.46 million. Okay, 9% rate of return, you're going to have $2.8 million. So let's say you do 8% rate of return. Let's say instead of $8,000 a year, you do, I don't know, $10,000 a year. Okay. Let's see how much that is. 8% rate of return, 2.7 million. Okay. Assuming 30 to 7 years old, you put away 10 grand a year from 30 to 70, an 8% rate of return. You don't even increase. You just go 10K a year, 30 to 70, you got $2.6 million. Okay. Let's say, and this is starting at 30. Let's say you start at 26, 3.7 million. So you can see the earlier you start, the more money you're going to have because it's based off time value return, compounded returns. But let's say you start at 35. You're like, I'm watching this video, I'm 35. 1.8 million, 1.79. So it's not too late, right? 35, you put away 10K a year from 35 to 70, assuming an 8% rate of return, which is very fair, considering the S&P 500's average close to 10% a year over the last 100 years, you'll have $1.8 million. Now, you'll say, yeah, time value money, inflation, that $1.8 million in the next 30 years, 35 years may not be worth $1.7 million. Fine, maybe it's worth $1 million. It's still $1 million tax-free if you did in a Roth, right? That money will help supplement Social Security. It can help you buy a condo on the beach, help you just have the freedom to not work, to maybe gift some to your family. So it's never too late. The system works. It's guaranteed. It literally is guaranteed. You just got to do these things. Now, the 401k helps you make up for lost time. Okay, so let's say you're 35 and you put away 20K a year. Okay, from 35 to 70, 3.6 million. Okay, it's never too late. Never too late. You can do it. I can do it. We all can do it. It's not a zero-sum game. We all can get rich through the system. It's literally rigged in our favor. We just got to take advantage of it. A couple more questions. What taxes do I have to pay each year if I trade in my trade crypto? Nothing. If you move money, if you sell money, cryptos in your IRA, it's tax-free, right? The only time you pay tax when you transact in a retirement account is if you take a distribution. If you don't take a distribution, you don't pay tax. Okay, the money in the retirement account is not subject to tax. So if you bought Bitcoin at 5,000 and sell it 60, $55,000 tax-free back to your plan, and then you can reinvest it. Ryan, the only time you pay tax is if you pull the money out of the IRA to use it. And then you pay, if you're under 59.5, tax and a 10% penalty. You can transfer assets between plans tax-free as well. Can you clarify the percentage that can be contributed to a solo IRA if gross income is 35K? So it depends on what you have. If you have a sole proprietor or single member LLC, it's Schedule C. So it's 35K is your net Schedule C. If it's W-2, it's 35K W-2. So the net, if it's Schedule C, let's say you made $100,000 selling widgets and you have $50,000 of expenses, your net Schedule C is 50K. And that's the number you'll use to do the 23 and then the 20% of that net number. If your company is an S Corp, C Corp, or partnership, it's the W-2 gross amount or the guaranteed payment, which would trigger the 23 or the 30K or the 25%. Okay, so you have to, it all is based off where and how you're earning your income. If you're a sole proprietor, single member LLC, it's going to be your net Schedule C number, which is on your tax return, which basically is your net amount of profit from your business. If you are an S Corp, C Corp, or partnership, it's your guaranteed payment or your W-2. Okay, so if you have an S Corp and you make $100 million a year, but you only take a $35,000 guaranteed payment or $35,000 W-2, that's what is key to your contribution. It's not your $100 million of profit, it's your $35K of W-2. Okay, so that's what it's on. Great questions, everyone. Thank you so much for participating on this Friday afternoon. I really appreciate all the engagement. It's a lot of fun. I can answer questions all day, all night. I love this stuff. Definitely tell your friends, family, colleagues. Every week. Next week will be on a Thursday. I generally do it on Thursday, but I was in New York most of this week, so I had to do it on Friday. But if you have other questions or comments, you can send them in, info@IRA Financial, or you can call us. We have a great, amazing team of tax and IRA specialists that can help you about questions about opening an account or investment questions or prohibited transaction questions or rollovers or transfers, conversions. We'll help you. Whether you're a client or not, we want you to have all the right information so you can make the best, most tax optimized decision for your retirement account and for your retirement investment strategy. So thank you so much for hanging out with me today. Have a great rest of your day, great weekend, and I'll see everyone again next week. Ciao and take care.